All right, thank you, Tayo, and thank you, Foma. You've done a very good job painting the scenario of what has happened in our markets and what we should be doing. Interestingly, while you were speaking, we had a host of questions, which is not unusual in times like this. So I'll take some of the questions and I'll mention who will be addressing them. So the first question is on market research. It says, will there be a recession in Nigeria? Or what's being done to prevent a recession, or worse, a depression in Nigeria, or devaluation in the Naira? So in a nutshell, the client is asking, what is your outlook on the economy? What's your view on currency? Informa, that's for you.
Thank you, Ayo. I think as we mentioned when we were talking about our expectations for macroeconomic indicators, the expectation is that there's most likely going to be a recession this year. And as I mentioned, two major points, contraction in oil sector GDP and a slowdown in all the others in non-oil sectors. Just to take us back towards when we had our last recession, I think 2016, 2017, around that period, it was largely on the back of a contraction in crude oil, in oil sector GDP. But in this particular situation, it's more like a double whammy for the country where you have sharper cuts in crude oil. We expect sharper cuts in crude oil GDP, largely due to a supply glut, which is now further compounded by a drop off in demand for crude, and then a slowdown in all the others in non-oil in the non-oil sector, largely as a result of a slowdown in economic activities. So we have lockdowns in key economies, Lagos, Abuja, Ogun, and right now, I think we're just in the third week of lockdown. We're not sure if this is going to be extended any further, but as long as the government continues to implement strict social distancing measures, depending on how long it takes for the government to contain the spread of the virus within the country, and how quickly we're able to, how quickly economic activity is able to pick up, we think there's more of a possibility of a recession. How deep that recession would be, I think at this moment it's too early to call, but like I said, how deep it will be and how quickly we're able to get out of it would largely be hinged on how we're able to manage the COVID-19 pandemic in Nigeria, as well as how quickly economic activities are able to pick up. With regards to currency, I think the risks for a further currency devaluation are high. If crude oil prices remain significantly lower, if the supply glut is there and demand doesn't pick up, as anticipated, there's every likelihood that the CBN will be under pressure to devalue the currency further. Most likely you would also see that pressure coming from even state governments that would be pushing for a devaluation to improve Naira revenues coming through as FAC allocation. So the risk for a devaluation are high, but then as we also mentioned, the key things we need to be looking out for, which, could give the CBN the ability to keep currency where they are. Firstly, the ability to raise multilateral funding. I think we've mentioned that quite a lot during this call. If they're able to do that, that should provide some buffer to the reserves. That should provide some ammunition to the CBN. If crude oil prices actually pick up, we'll see some accretion in revenues coming to the federal government, and we should also see some buffer to the CBN on efforts and things that have been done or things that the government is doing, to prevent the country from going into recession. I think it's also important to highlight that our federal government is under a lot of fiscal pressure. So unlike developed markets where we've seen in the news announcements of historic stimulus measures being taken, for for Nigeria, where most of our revenues come from crude, and you have a significant drop in crude, there's some sort of limit on what the federal government can do in terms of fiscal buffers. And so whilst that pressure is there, we've also seen some activity from CBN coming up with some measures on how they intend to bolster the economy and provide support to businesses at this time. I hope that answers the question. Thank you.
Yes, it does, Ifeoma. Well done. So the second question here is, how can I take advantage of the market at times like this? I would like to invest in shares. What should I buy? What are the investment options available given the COVID-19 pandemic? So in a nutshell, should I buy equities, EVS? What sectors should I consider? Tayo, that's a question for you.
All right, Didi, thank you very much. So we talked about the equity market extensively, and we had focused also on historicals, right? And the reason why we did this is try to make you understand as investors that there are always opportunities to take advantage of. And as long as you are able to do your research, sound fundamental, sound security selection, you'll be able to take advantage of whatever opportunities. And there would always be opportunities for you to buy and opportunities for you to sell. Now, we've also talked about GDP and our expectations, and I'll just give you specific names, like I had mentioned earlier, on sectors and some specific names you can invest in. Because what happens in every sector, there's always that opportunity. There are always should I call them the blue chips, or the names that everybody likes, the top performers, or those that have large market shares that you are able to take, expose your portfolio to. But those that have good, strong fundamentals, those that have good corporate governance, those are the little things you look out for as an investor. So we think part of the sectors that will probably be able to withstand the volatility currently in the markets and the times we're in are the likes of the telecommunication sector. And in that sector, most preferred name is MTN. Then we then go straight to Agric. And the reason why we think Agric could be able to sort of minimize the impact of this segment is because people would always consume, right? They would always eat. Now, the only clause to that, however, is if commodity prices move significantly, if there's any significant or drastic change in commodity prices, then it means that we might then see that impact the agricultural sector negatively. Coming down to consumer goods. Now, consumer goods is a very interesting segment, and as much as you might readily say everybody would eat somehow, they need to consume one degree of item or the other, but you also need to look at some factors that I talked about or spoken to when I started answering these questions. And in that segment, our top pick basically is Nestle, and the reason why we like Nestle is because of their strategy in trying to penetrate the market and being able to segment and create a niche for themselves. You can then begin to look at some nitty-gritty that we are always available to talk to you about when you're ready to invest. Services, okay, I talked about services. In the banking space, we like two names, very positive, that we believe that in the next 1 to 2 years, in as much as there might be some volatility based on people taking speculative actions and selling those names, the structure the banks have created is one that we believe would be able to withstand current market conditions. And in that segment, we're positive on GTB and Zenith Bank. One thing I need to state is that there would always be opportunities. Markets, for example, as of March 28, I've done -20. As of today, about -15. What has happened is there's been that upside, that small rally for a few days that an investor can take advantage of. But when investing, you should always focus on the fact that fundamentals are very key. Once you find an opportunity to invest, to buy because it is underpriced, you can go ahead and take advantage. Thank you very much.
Thank you. I think one thing that is also important to note is that for exposure to equities, it has to be patient capital, people that are willing to go at it for the long term. We have another question here on real estate. Thankfully, the MD Mixter Nigeria, Kola, is on this call. So Kola, this question is for you. What do you think will happen to our real estate investments in the near future? Should I buy real estate now or stay put? Kola?
Hi, Ayo. Good morning, everyone. Well, I think the outlook that the team has shared has been quite insightful in terms of the expectation of a recession. And what this means for real estate is, as typical, real estate always takes longer to come out from a recessionary period. So what that means is that whatever investment that you're making in real estate has to be for a longer period of time. You have to have patient capital that would be for that longer period of time. But it's quite interesting to note that during recessionary periods like this, or expected recessionary periods, real estate yields are more competitive to other yields. So I looked at the dividend yields that Ifeoma had mentioned just earlier. Real estate yields are now more attractive. So we're going to be seeing a lot of interest in the real estate sector. And given government policies, we've seen some recent guidelines issued by the central bank that there's going to be a lot of focus on affordable housing and mortgages. So if this do come through, we think this would be quite positive for the sector. But from an investor perspective, I think you have to look at this from a sector basis. So for the office and commercial side, you have to be more long-term focused. During a recession is not the time offices or new businesses will be taking up office space. But you can make an argument that the Class B and Class C offices will be attractive, but definitely not Class A, which are the premium real estate spaces in your highbrow areas of Ikoyi and Victoria Island. The retail side, the strategy there would be more of a neighborhood type retail. People will still shop, but people will not have that much discretionary income to spend in malls and things. So you have to be very careful there. On the residential side, which is where we focus mostly in Mixed Africa, we look at it from two perspectives. From the high end, the high end side of real estate in Nigeria is driven mostly by businesses. It's businesses that are looking for places for their high end their senior executives to stay. So if businesses are not expected to do well, then you can expect that rents would depress. You see some depression in rents and demand for high-end properties. By the end of the day, I think in the middle income and lower income area, which is where we really offer most of our products, you still see demand. People still need housing. There's still going to be a lot of demand for housing. And for as long as there are activities, there are more macro or general activities like a refinery and things like that that are happening that are affecting the market, we still think demand will be strong. The prices, now is a relatively good time to get involved in real estate. Prices will be depressed because you would see developers try and offer discounts to attract buyers. But one has to be very careful in terms of which developers you're going with, because most of the developers, the recession would actually affect most of the real estate developers' businesses out there. So I think that kind of summarizes the sectors that we should play with. Again, real estate is not as volatile as the equities or as the equity market. So it's quite stable. Your rental income is stable, but you have the risk of the tenant defaulting on your rents. You know, at the end of the day, people still need places to live, to work, and to get services. So we're quite positive on the real estate play for the long term, and it's something that investors should continue to look at. Thank you, Ayo.
All right, thank you very much, Kola. I mean, you did a good job shedding more insights into the real estate space. I have a question for Kai, and it goes this way. I'm quite impressed with the level of engagement and the service I have received from your organization during this lockdown. Is the team equipped to continuously deliver timely service if the restriction continues longer than expected? Kai, that's for you.
Thank you, Ayodele. And I was saying absolutely, in the last 2 years, we have dedicated time and resources just to revamp our alternative channels and redesign our business continuity plans, which I mentioned earlier. We've also trained our people. And so we just know that they're in a good place to continue to serve seamlessly, especially at times like this. And so I have no doubt that we'll continue to provide these services, to our clients. Furthermore, at times like this, we're taking advantage of the opportunities to do things differently. And going forward, we intend to hold more webinars and, use this as an opportunity to discuss markets and different areas of interest where we believe our clients would be able to take advantage of. So I really believe that we're in a good place. Thank you.
All right, thanks a lot, Kai. Another question, Ifeoma or Tayo, any of you can answer this. It says, a top influential Nigerian politician has advocated that government should print more currency. If this suggestion is accepted, what will be the impact on exchange rates? You may also want to add inflation to that. So Ifeoma or Tayo, any of you can take that.
Thank you, Ayo, for the question. Printing money, I guess it's a tricky one, and it's a conversation that most central banks tend not to have regularly because of concerns that once you print money, what tends to happen is you increase money supply. And once money supply actually increases, then there is some impact on inflation. So inflation is expected to trend higher. On the connection with printing money and the exchange rate, I think the connection isn't so clear-cut with regards to the impact that it could have. So one could argue that with inflation higher, the federal government might have to increase rates, and then when your interest rates are higher, that could increase demand for your domestic instruments, and then of course improve exchange rates. However, it's also not that straightforward, because once you have inflation coming up, the real value of your investments is the real return. It also affects real return as inflation comes up, and for foreign investors, they could view that as negative when you have higher inflation, and then your real return declines, and then of course there's also no demand for your local instruments, and people will just want to will I say, for lack of a better word, dump your currency. So it's not clear-cut, the impact it could have, but I think one thing that is clear is once you do that, there's actually the likelihood of inflation moving higher. Thank you.
Okay, thanks, Ifeoma. I mean, what I hear you say is that it's more negative than positive because inflation will creep in. Am I correct?
Yeah.
Okay. Thank you for that. So one more question. I mean, my dear clients, we have a whole lot of questions, and I doubt that we'll be able to answer all those questions during this session. We will take a few more questions, and we will reach out to you directly to answer specific questions. So I'll take a few more. Tayo, this question is for you. What is driving the increase in USD investments despite the COVID-19, and what will be the impact of low oil prices in the country, both short and long term?
Let me take it from the impact of COVID, because I know the client mentioned COVID-19. So the pandemic has happened, is affecting every country, and there's going to be slow demand for various commodities, oil inclusive. What then happens is that for countries that are highly dependent on this oil or prices of oil, you're going to find out that there will be some pressure on their revenue base. Now, countries like that, Nigeria, Angola, if you look at those countries, Ghana inclusive also, what has happened is the yields have gone up significantly. So the way the fixed income market works is that you find an inverse relationship between yields and prices. So the yields have gone up, the prices are relatively cheap. So what's then happening is, because of the risk that people see, investors have sold that instrument and the prices have come down, factoring in the risk. So that is what has led to the increase in yields for Eurobond instrument, for Nigerian-based Eurobond instruments and other countries alongside. The question then is, going further down the line, recollect that I had mentioned that as long as we, as a country, Nigeria, do not diversify our income stream or our revenue stream, as you may call it, what it means is that we would always continue to see that volatility on revenues, see that volatility on external reserves. And what would happen is any investor that wants to come or that wants to lend money to Nigeria, what they'll be looking at is, okay, because it is a foreign denominated instrument, what it means is that I need to look at where your reserves are. So there are a number of factors they look at: debt to GDP, debt to revenue, a number of factors they look. They will also consider oil prices, very important because of the impact that it has directly on our economy. So in the short to medium term, Ifeoma talked about the outlook. As long as we do not, oil prices do not pick up, the pressure would remain. If oil prices remain pressured at these levels, what it means is that the pressure on our revenues, the pressures on our reserves would remain. And they will continue to, there'll be that risk of sentiment, meaning that investors will just be shy of Nigeria and they will not want to invest in Nigeria. So in the short to medium term, like I had stated earlier, I specifically stated that we should look at the next 1 to 3 years, right? As long as the demand picture for oil prices do not change, then we would have pressures on our reserves, and as long as we don't diversify our income stream, then you will then begin to see pressures on the currency and eventually maybe a depreciation or a technical devaluation, as you may call it. What the CBN then does to respond to this would also be very important. Either they decide to say, okay, let us devalue the currency to where we think it should be trading at, and then you see a free market and you then begin to see a lot of volatility in the Naira. I hope this answers your question.
Tayo, yes, it does. As the portfolio manager, what does all this mean for investors' portfolios? What action should I take? Should we stay calm? Should I change anything in my portfolio? What should I do at this time? I'll take that question there myself. I think what is important at this time is to revisit our financial plan. If we've drawn up a comprehensive financial plan in the past, this is the best time to go in, revalidate our goals and objectives, and see if they are still in line with what we want to achieve, given the uncertainties that is upon us. And if we haven't drawn up a financial plan, I think there's no better time than now for you to reach out to us so that we can set up virtual meetings to have that conversation. It's important to stay focused, stay disciplined. But in doing that, we need to reassess our goals and objectives and see if they are still valid. And based on that, let that be what will drive our decision making going forward. At this point, there's no need for a knee-jerk reaction or to panic. We need to stay focused, disciplined, and committed to our goals and objectives. I have another question here that I would like to take. It says, for those investors with extra cash on hand, what would be an appropriate trigger and subsequent methods for putting cash to work? So Ifeoma, that's for you. What are the triggers to look out for?
Okay, I think to answer that question, I think the first thing would be, I think similar to what Tayo had mentioned earlier. So if you have extra cash and you're looking at what to invest in, I think there are several opportunities, but that would also depend on your risk appetite. So if your risk appetite is high, you have extra cash, you're liquid. Liquidity is also good at times like this. It helps you pull the trigger when you need to. You could take position in you could actually begin to build a very good equity portfolio at times like this when markets are depressed significantly. As Tayo mentioned, it's very difficult to call the bottom. So what I would recommend would be for an individual to stagger purchases. So because nobody really knows the bottom. Most times what happens is you know the bottom the day after. So the bottom has hit, you don't know it's the bottom, you think tomorrow is the bottom, the next day goes up and it keeps going up. So I think what's important is to stagger purchases, especially if you're looking to equities. If you're looking to deploy your extra cash to fixed income securities, given our expectations that yields would most likely inch higher, given macroeconomic conditions, that possibility is actually there. I think one thing we're going to be recommending is to invest in short duration fixed income instruments. That would also provide give you the ability to take advantage of interest rates when they move higher. I think that's about it. I hope I've answered the question. Thank you.
Taya, just a quick one. I know you mentioned it through your presentation, but I've seen it pop up a couple of times, so you may need to address it again. What should we do with our fixed income investment? Should we stay short? Should we go long? Then a follow-on question is, what are the prospects for commercial papers? It seems that their rates are quite higher than the conventional bank placements.
Okay, thank you very much. So for fixed income instrument, the outlook or expectation is that rates will inch up higher later, maybe this year, sometimes next year, but I think it would clearly inch up higher from where we are currently. Because what investors are doing is, because of this expectation, everybody's played in the short end, meaning that they are doing bank placements, doing short-term instruments, CPs and all that would mature in less than a year or maximum of 1 year. And it makes sense because by the time you go down the yield curve is where you look at your maturities and the interest rate you are earning on those instruments. For example, it says a 2-year instrument is trading at 7%. The question is, in the next 2 years, where do I expect Nigeria to be? What is the fundamental picture? How do I expect Nigeria to generate revenues? How will they fund the recurrent expenditure? So you look at all that and you're then able to assess if indeed I'm ready to lend money to the government at 7%. Then we come to, so basically for fixed income instrument, the strategy is short term. If you are invested at the long end currently, meaning that you've done longer dated investments, what it means is that at this current prices, dependent on where you bought, you can actually sell them, meaning that you cash your profits and you move your cash, stay in short term, and when rates goes up again, you take advantage of that. So for CPs, what has happened is that, yes, yields are attractive compared to what you would find or earn on a normal fixed deposit with the bank. You could look at, or maybe it's depending on the tenor, a 3 to 5% upside, which is the differential between what the bank would offer you and what the CP would offer you. But what we need to be aware of is the fact that once you lock in those CPs and you need liquidity, then there might be challenges. And also remember what we went through earlier this morning. Focus on your liquidity risk. Focus on your on trying to manage concentration risk, which is diversifying your portfolio. Then we should also know that every CP, the reason why they are offering a premium is because the risk is higher, the credit risk is higher. So before you invest in any CP, you need to do a credit analysis of the CP and see if indeed it's worth you deploying your funds into the commercial paper for the time period, just to ensure that you are able to manage any form of default risk on that instrument. I hope that answers the question.
Okay, thanks, Tayo. Ifeoma, this is a question for you. Can you please give an overview on the global markets, just very succinct overview on global markets, how that would impact Nigeria?
The global markets this year have been roiled by all that has been going on, all that we've spoken about this year. And we've seen both frontier, emerging, and developed markets take a hit. And that's largely because investors have been fleeing to safety, looking for safe havens, and we've seen the equity markets across the globe take a significant hit, and on the back of all that has been going on. And with regards to how that affects our own markets, I think our own situation is also somewhat peculiar because of specific issues that we've had over the past. Like I mentioned, even as of last year, when developed markets were reaching all-time highs, our own equity market was struggling, and we began to see we saw sell-offs from mainly foreign portfolio investors on concerns, as I mentioned, that the economic growth was lethargic. There was economic growth wasn't picking up as much. I guess a lot of investors felt the country was a bit slow in putting in place policies that would provide some support for the economy. How things play out for our markets and also for developed markets is, like I've mentioned earlier, I think everyone is waiting for a lot more clarity around what's going on with COVID-19. Once there's a lot of clarity around that, we actually do think that we could begin to see some sort of recovery in global markets. On the other hand, for Nigeria, given the peculiar situation that we faced even before we had issues this year around COVID-19 and the sharp slump in crude oil prices, there's been some concerns that our own markets, might not experience the same rally. But I think one thing that is also important to note is the amount of stimulus, that is being put out by most developed markets, the central banks in most developed markets. And, when you have easy money coming in that way, there's every likelihood that, once economic activities pick up, there'll be increased demand for risky assets, and the Nigerian equities market could benefit from that. We saw that 2013, 2014, 2015, when we had quantitative easing and we had free cash flow, we had a lot of easy money, and then of course we saw some of the impact there. So despite the fact that we have peculiar issues, we note that there's a possibility that once things settle or the situation is a lot more improved on the global front, and with the quantum of stimulus being pumped into different markets, there's a possibility that our own equities markets will benefit from that. Thank you.
All right, thank you, Ifeoma. I think with this, we've come to the end of the Q&A session. We have a lot of questions on queue. So what we will do is that we'll reach out to you directly to address some of those questions. Thank you so much for spending time with us. We're very happy to have shared our views on the markets. But just a quick recap before we close for today. I think in talking about the different asset classes, what we've heard is that with real estate, the opportunities are still there. And in times of recession, such as we are in now, real estate yields are somewhat better. But it's also important to dimension which segment of the real estate sector one will be playing in, and also have patient capital. For equities, very interesting asset class. Equities tend to outperform in the long term. Even when we've seen different market cycles, equities have always done, they've always come out of the woods. But what is important is to be a bit more discerning, look at the economic events, look at which sectors will benefit from that event, and then go to specific companies that would do better than the rest. So obviously it's important to also be handheld by a fund manager that has robust research capabilities. For fixed income, our view is that for now, given the headwinds we see in front, and for now, our view is to stay short, and as interest yields go up in the near term, we can then start to rotate our investments towards the long end of the yield curve. For currency, there's always a case of having exposure to currency, particularly if you take a long-term view. Currency, US dollar versus Nigeria, the outlook is that the USD would always do better. And even if we look at it over a multi-year period. So those are the key takeaways. In addition to that, some of the things I like to say is that these are unusual times. However, there are opportunities, and it's those that are discerning and disciplined and stay focused to their investment goals and objectives that would tend to benefit from times like this. Therefore, what we will advise our clients to do is to reach out to us via the email address on the screen, wealthadvisor@arm.com.ng, so that we can have a conversation around your goals, your objectives, what you should be doing in these times. The reality is that, yes, we've passed on a lot of information, but the truth is each individual is peculiar because of their liquidity requirements, their goals, their objectives. So it's important that we have that conversation with you, and we can provide more insights and clarity where needed. Like I said earlier, we will reach out directly for the questions we're not able to take. We'll reach out directly to you and address those questions specifically. We wish to thank you for listening in, and we ask that you have a pleasant weekend. Please continue to stay safe. This is an event that will pass. Thank you very much, and bye for now.